So welcome once again, and we'll get started with this wonderful topic today, which is understanding ratios in the insurance industry. So this is an overview of a detailed session that we do, but nevertheless, it gives an insight into what are some of the working ratios, operational ratios, the financial ratios, results. How do you measure the performance of an insurance company? Very, very important from various angles. So the most common rating factor for an insurance company, or for that matter, even reinsurance company, is the credit rating, right? CRISIL rating, as we call it. So almost all insurance companies have a CRISIL rating. So if you talk about the large corporates who are engaging in purchasing insurance program, they will definitely ask for the insurance company with whom they plan to place the portfolio. They will definitely ask for the CRISIL rating. And similarly, in the case of reinsurance as well, whenever you talk about large projects or large industries which go for insurance, definitely not only the insurance credit rating will be asked, but also the clients would like to know who are these insurance companies backed by, who are the reinsurers, what is their financial rating, financial stability rating, if you could put it that way. So it's very interesting that ratios play a very vital role in the insurance industry. We look at some of the very common ratios that are relevant on a day-to-day transactional level. And before we get into the presentation, I'd like to encourage all of you take out some time. I'm sure as professionals, it's very important if we want to be totally updated with industry. It helps to look at some of these key statistics that get posted on the IRDA website. The main one being the segmental business analysis. See, the more and more we drill down, obviously this report is not something you look at it and you get to know what it is, but it's important to engage with these statistics to get deep understanding, to understand the current trends in the market. One source is the IRDA website, and also if you go into some of these insurance company websites also, right? Be it the private companies or the public sector companies, if you run into their websites, there is a section which talks about reports for public disclosure. It is mandatory, it is regulated for insurance companies to put out these valid statistics for customers to see and evaluate where they stand in terms of their performance. So I would urge you to look at these information. If somebody's raised a hand, would you want to post your question on the chat? Meanwhile, I will just share the presentation. We get started with this. Is there a question that you want to post on the chat or the Q&A? Okay. Okay, so let's get started. So like I said, insurance, to a layman or somebody who is a common customer would just look at it as his own risk protection. But insurance is a business. It's an enterprise. It is anybody who's having an insurance company also runs it like a business. He's got to manage his portfolio. He's got to manage his business to ensure sustained long-term growth, right? So now fundamentally, we know what is the purpose of insurance. We know that it is to bring the people who are exposed to similar risks together and to share the risk. Right? So we have different kind of risks. We pull them together and then we share the risk, where the premium is collected from individuals and paid to those few who meet with loss. But this is a going concern. Now, every insurance company also follows the business fundamental principle of going concern. So it's got to maintain a sustainable and growing business. And in this sense, ratios become a very, very key parameter for them to observe and watch. So these are certain key terminologies that I'd like to introduce before we get into ratios. So something called gross and net, which is very, very key, very important in the case of an insurance industry. Most of you would be aware of it. Just want to give an overview. So when you say gross, the gross elements are gross written premium, GWP. And when you say GDP, it is gross direct premium, right? These are not the same. I want you to understand these are not the same. When you say gross direct premium, it is all the accrued premium, accrued business. So premium means what? Sales, revenue for an insurance company. So there is a distinction between GDP and GWP. Both are gross, but at the same time, when you say GDP, it is the business that is accrued. When you say GWP, the business that is received. I can give an example where, let's say you have a long tail project insurance. GDP will include the premium for the entire project period, which you have not really received. Some of the installments could be due. GWP is that premium which you've actually received and written in your accounting books. But nevertheless, both are gross premiums. And then you have gross claims, typically claims. So what does an insurance company do? It pays claims, right? So when you say claims, obviously there is, you pay out claims, and there are also a few claims which are in process. We call them outstanding claims, right? So paid claims plus outstanding claims together is something that you call as gross claims. And to this, we add something called an IBNR. We look at it in a further slide, which is nothing but incurred but not reported. And you have gross commissions. So every company pays commissions or brokerage, which is again in the gross bracket. Now come to the net. Typically, if you want to understand the difference between gross and net, the impact is at the reinsurance level. When you say GWP, it is just the premium that you receive from the client. When you say net NWP, net return premium, you will have to deduct the reinsurance premium that you would pay to your reinsurer for the kind of arrangement that you made with them, right? So gross premium less reinsurance premium becomes net. Obviously, on the front, many some of you are beginners. You know that gross and net is defined as including GST. That's a very fun, basic learning. But here we're talking about the detailed ratios. So here I want you to understand the distinction between gross and net is essentially the reinsurance part. Now, similarly, gross claims, net claims. When we say gross claims, it is the claim that actually needs to be paid to the client. When you say net claims, then what you pay to the client and what you in turn recover from the reinsurer, the net, the difference, that is actually on my net, right? My net claims is nothing but what I pay minus what I get back. That's what I'm paying out of my pocket. So clearly establish the distinction between gross and net. So gross claims less reinsurance recoveries is net claims. Similarly, the commissions. Gross commission is something that I pay to my agents and brokers, the total. Net commission is on every reinsurance placement, I get reinsurance commission from the reinsurance company. See, like I said, the business of insurance is all about doing insurance business at the same time protecting my risk with a reinsurance setup, reinsurance arrangement. So direct commission less reinsurance commission will be the net commission. So clearly I want you to understand the difference between gross and net. So right now I hope it's clear. Just to summarize, GDP is the awarded premium. GWP is the booked premium in that particular financial year. Net premium is GWP less reinsurance that you have given out. And net earned premium is also one aspect. It's a very longer concept. We detail with UPT in our detailed session. But right now, I want you to understand when you say NEP, there is also a factor which is called earnings. That means every policy is issued for 1 year. So let's say you're measuring the premium at the end of third month. You have earned the premium only for that first 3 months. The remaining 9 months are still open. It is unexpired. It's still to come. So you need to keep some portion of your premium in case there is a loss during the period that is yet to come. For every policy, isn't it? At a given point of time, you have an expired period, you have an unexpired period. So on every policy, it gets calculated like this. And so net earned premium will mean there is another factory other than reinsurance. You also factor the earnings based on the expired and unexpired portion of the policy. Now, having seen the premium aspects, we'll move to some more detailing of the gross loss ratio. Like I already said, gross loss ratio is clearly the total claims that you pay to your client on the face, and you need to add in process also. Every claim that is in process is put up with a certain outstanding reserve, right? There's something called an outstanding reserve that is set against each claim which is in process. An estimate of a claim that this much could be the size of the claim. It can be plus or minus. Eventually, the actual claim can be a little more or a little less, but nevertheless, around approximate amount has to be kept aside as a reserve. And so claims outstanding reserve is also considered into the gross loss ratio. So now having seen premium, gross and net premium, gross and net claims, we're looking at the first ratio, which is starting with gross loss ratio. It is nothing but total claims paid plus outstanding divided by gross written premium. It is not gross direct premium. It is gross written premium. Now, when you talk about a gross loss ratio for any insurance company, if internally, if you see the various departments, the way they work, they use this GLR for every portfolio, a line of business like health or motor or property, just to see how the portfolio is functioning. For every policy, nowadays the software is such that you can pull out any kind of report, isn't it? So a review of a portfolio to keep sustainable growing business as a going concern, as a concept, these are key ratios. For every portfolio, you need to see GLR. For every policy, right? You look at the GLR, how is this policy functioning? For every client, why? Because a client can be giving multiple policies. There could be a health, there could be a property, there could be their motor fleet, there could be their marine portfolio. Everything put together, how do you look at the holistic view of the client's portfolio performance? So you look at the GLR of one particular client, you look at the GLR of one particular intermediary. It can be an agent, a broker, a corporate agent, a bank tie-up, where you want to know the efficacy, you want to know the overall quality of business placement through that intermediary. So you try to measure it with a GLR of one particular intermediary, and also period specific. You want to know, which quarter you really made good, a healthy loss ratio. So at every quarter end, if you typically look at portfolios like health and motor, which are more, trends, they're experience based. It's not like you have one big claim. It just keeps happening and you want to understand the trend of claims. In that case, the gross loss ratio is looked at every quarter, maybe once in half a year or a full year analysis. Now, having seen GLR, another key important ratio that is there is the EILR. Very, very important terminology that you need to know. Earned incurred loss ratio. Now, how is it different from gross loss ratio? Now, here's where I want you to see the definition there. Here we're talking about the net. We moved from gross. If you see the formula, total claims paid plus claims outstanding, which is at the gross level, less reinsurance recoveries, which means, like we already saw in the earlier slide, it is NIC. This is not gross loss, this is net loss. That means you are factoring the reinsurance recovery as well, right? So net incurred claims. So what we have put on the numerator, it's like a fraction, right? You're able to see the fraction is, we are talking about ratios, and so we're bringing it out like a fraction formula. Total claims paid plus claims outstanding less reinsurance recoveries. This is the numerator, divided by net earned premium, which is the denominator, right? Because the premium is something that have in your pocket from which you need to pay the claims. And how healthy is this ratio? Do you have enough money to pay out claims? That is the indicator an EILR will be able to give you, right? So it is ideal. It is ideal that again the EILR in respect of a portfolio, a policy, a client, or in a particular quarter, or for half year or full year, EILR should definitely not cross 100%. That means it's a loss-making portfolio, loss-making policy, right? You have some premium as a denominator. Now the numerator should not be more than that. The claim should be within the premium that you have earned, right? So ideally the EILR should be less than 100%. And if you really are looking at a portfolio which is profitable, which is lucrative, right, then the ratio should be somewhere staggering around 75 to 80%, which is extremely good, because there will be overheads, right? To every loss ratio you have costs, management expenses, and many other expenses that an insurance company will have to bear. Now, these are some key statistics that we just try to pool. Now, some of these insurance companies, you could see these are, again from the IRDA website. So they're all out there. These are all public disclosure, right? So this is a recent, I think this is not this completed year. This is not 2021, 22. They are not yet audited. It is a previous year, but nevertheless gives you a certain trend. Now, concept of IBNR and IBNER, like I already said, when you factor EILR, you know the basic loss ratio for those claims which have been paid and which are in process. That means they have been intimated to you. The claim is on your desk. As an insurance company, I have received the claim. And I know some I have paid, some are still outstanding. But the concept of IBNR is incurred but not reported, unreported claims. See, always we would expect that there are claims in pipeline. The client has discovered them but not yet reported, intimated to the insurance company. It doesn't happen in the case of a property or in the case of a marine, where the insurance companies do insist that the claim has to be intimated within reasonable time, isn't it? It's a policy condition. There should not be any delay in intimation of claim. But this is very valid. IBNR is a very important statistics or measure to look at the exposure on third-party claims. Third-party claims get intimated very late, isn't it? The accident might happen today, and you have already struck a claim, but the whole process of the person filing a suit in the court and then the notice being received by you, it takes some time. Definitely it takes time. So there's a chunk of claim, especially in the case of third party, which are accrued under the IBNR category and also under health. Wherever there is an intimation clause where there is reasonable time for people to intimate claims. In the case of health also, there will always be IBNR claims. Maybe so as a rule of thumb, there is no sanctity to this, but as a rule of thumb, right? Generally, insurance companies follow almost 4 to 5% of an IBNR percentage, which is like, if my EILR, if my EILR is, let's say, 75%, I would definitely add another 4 or 5% towards IBNR. because this is something that I have not received. So one is IBNR, which is unreported, not at all reported, not reported, NR. Another is NER, incurred but not enough reported, right? So which means that it is under provision. We don't know the full description of the loss. So quite possible that the estimate of claim that you have is also much less. So you need to provide for that also as an insurance company, right? So IBNR, IBNER as a rule of thumb is also added to the ALR to arrive at the actual loss ratio. So we've seen GLR, we've seen EALR, we also saw the concept of IBNR, right? Now we're moving to COR. This is another very key ratio, very important ratio in the insurance industry, which is called combined operating ratio, COR, right? Now COR, again, you can see the formula in which it is highlighted there. EALR, we know, is the earned incurred loss ratio. Plus, like I said, it is not just claims. There are many other expenses that an insurance company will incur. That also you need to pay out of your premium only. Only then you know whether the business is overall making profit or loss. So a COR actually tells us whether the insurance company is making operational profit or operational loss. So to the loss ratio, you add net commissions, because obviously every company has to pay commission to source business, and the other management expenses, which are in terms of your rent, salaries, communication expenses, marketing expenses, or any other running expenses, right? Operational expenses. So these are expenses which also need to be added to the ALR and commission, divided by the net earned premium, again NEP. So with this you arrive at what is called as the combined operating ratio. Now, having, again, the COR is not actually seen at a portfolio level or anything, it is at a company level. Always COR is looked at a company level. It doesn't happen at a like, unlike we saw EALR happening at a portfolio, policy, client, a period, all those are metrics. But COR is at a company level, which is generally reviewed once in half year or in a full year. So the indicator is basically if any COR is less than 100%, then there is an underwriting surplus. That means that particular company is making business with operational profit. There's something called investment profit also, which is purely, the interest that you get on the investments that an insurance company makes. We're not talking about that. We're keeping that aside. That comes on the balance sheet level. But right now, loss, commission, plus other expenses, how much are you paying out of your premium? Essentially, this is the ratio which is called the combined operating ratio. These are some figures again. We're just trying to see, the lowest ones, the best ones, and the slightly above 100 ones, for you to get an idea how these measures work. Right. Now we move on to another key ratio, which is called solvency ratio. Solvency ratio is a regulated requirement in the country. So IRDA, which is a regulator, insists, or it is a regulated environment where every insurance company has to have a minimum solvency ratio of 1.5, which is nothing but your assets need to be 50% more than your liabilities. This is the law of the land. This is something that minimum any insurance company has to maintain. When you say solvency ratio, what is my asset capacity to pay my liability? I have certain liabilities towards my policyholders and customers. So am I prepared financially? Am I stable enough to pay those liabilities out of my pocket? So it can be my pocket or the reinsurance, all that is also factored in that. But all I'm trying to tell you is this ratio needs to be at 150%. the asset has to be 1.5 times the liability. So there's a detailed way to calculate this. I've just given you a few acronyms here, short terms. ASM is called the available solvency margin. RSM is called the required solvency margin. When you say available solvency margin, it is the excess of value of assets over that of liabilities. Clear? Like I said, how much is your asset more valued than the amount of liability that you liability means what? It can be your loans, it can be your claims, and all other outgo that is due from your side. Okay? Asset means what? Definitely the revenues, the premium, the income, and many other fixed assets. Maybe companies have invested into property, or they have some, the investments that they have. Some companies have huge reserves. If you talk about the public sector, they have huge reserves over a period of time. So any asset, any asset that is to the benefit of the insurance company is taken, and that should be 1.5 times the level of liabilities. When you say required SM, required solvency margin, it is to be computed by the norms laid down by IRDA for each class of business. So like I said, it's very much regulated, and it would be so obviously it is the solvency ratio as such is looked at a company level, but how you calculate and arrive at the cumulative solvency ratio, there's a detailed guideline and method laid down by IRDA, which also I do have. Okay, I don't have. That's part of the detailed program. But solvency ratio is also very much put out on the individual company websites, or if you could also find this out on the IRDA website. So, if at all, whenever the solvency ratio drops, it is important for the insurance company to go back and put some more capital and raise the asset level to ensure that the solvency ratio is kept at 150%. Another key important ratio as an indicator is to see the commission expense ratio. Very important ratio. So this is an indicator of expenses towards commissions. How much of their business is B2B? See, right now, if you see many companies focus on B2C, they try to sell policies through their own web portals or through their own employees or low cost channels. So how efficient is the distribution funnel? So this is an indicator to find out how efficient is the distribution funnel. So a low commission expense ratio will usually translate to lower premiums. It depends on it. But these are indicators to analyze the company's focus areas. Right? A higher commission expense ratio could also be, lower discount offered, leading to a higher premium pay. Various combinations that you can really analyze and look at the data. A negative commission expense ratio also is possible. How is it possible? Some company is smart enough that they pay X amount of commission to their front end agents and brokers, but their reinsurance scheme is so good that they're able to get more commissions back. And it doesn't happen very commonly, but at the same time, negative commission expense ratio is also there. Like, also in the case of direct scheme participations, you have a situation where when you participate in government schemes, generally there's no commission and the premium is very large, isn't it? So some companies try and focus there, build their brand, and try to keep their commission expense ratio at a check, like we saw minus commission ratios. Now another important ratio is also the claim settlement ratio. This also you can see if you go to the individual website of insurance companies. Definitely in the public disclosure segment, you will find they have to put out the CSR, right? So when you say higher the settlement ratio, then the chances of settlement of a claim is much quicker. Right? How many of their claims are they settling? It's a very important measure to check the insurer's reputation. So this was another statistics that I pulled out from LinkedIn. Somebody had shared, and this is how, for the year 2019, though old data, but nevertheless, it gives an indicator of how the companies fare in terms of claim settlement ratio. Right? So when you say a company has a claim settlement ratio of 92.44%, that means almost 92 out of 100 claims they are settled, which is a very, very good trend for any company. The pendency or outstanding claims are at a low level. And then we also have something called a persistency ratio. So this is very interesting, where it shows how much the insurance company focuses on customer satisfaction. So this ratio indicates how persistent a customer has been in renewing their policies with that particular company. So this is also a measure to check how the insurance companies are in terms of their customer loyalty, customer satisfaction. Right? So one thing is the brand value which you get in terms of customer satisfaction, but a very easier metric is to check the persistency ratio of a company, which is again a part of the public disclosure segment. So it is measured at different levels, different intervals, right? These are indicators of customer satisfaction. So some examples here. So it is also very, very important in the case of life insurance, because it's not like a renewal, but it is a continuity, right? So how many people have discontinued their policy? So it also calls for engagement by the insurance company with the customers, of how they engage, how they persist on the customer continuing their insurance portfolio. You would see, if you have a life insurance policy installment that is due, how they chase you, because they have a certain metric called persistency ratio, more common in the case of life insurance. So this is a brief webinar that we wanted to cover, and these were some of the key ratios. We do have a detailed program where we deal how these are arrived with hands-on workshop experience. But nevertheless, I wanted to leave you with a few terminologies which I'm sure helped you. So the idea of doing these short webinars is to engage with you people, give you a few terminologies that you can start using in your daily transactional language, right? So we encourage you to come back to each of our free webinars and make use of them. I'm just leaving you with this one slide where, like I said, the credit rating by CRISIL or even the AM Best, these are credit agencies, right? So it's important that every insurance company has a credit rating. So the typical formats are AAA, AA, triple B, like this. Like I shared in the initial slide itself, that credit rating it's not a ratio, but it's definitely a rating scale, an indicator to know the efficiency of an insurer. So with this, I think we've run out of time. This is a very, very short log. I'm sure it is encouraging all of you to come into short webinars like this. But nevertheless, if you are interested in deeper understanding, deeper knowledge, please do enroll and come in for the detailed courses. We'll be more than happy to sail with you as your learning partner. Thank you so much for joining. We would like to stop here. We look forward to having all of you in the next free webinar. Please mark the date every Friday, 5 to 5:30. Let your friends know, and whoever would find it useful, please let them know. Thank you so much. We'll close this right now. Thank you.